Okay. On this week's episode of the Crushing Debt Podcast, Uncle Sam wants you to pay up. So, welcome back to this week's episode of the Crushing Debt Podcast. My name is Shawn Yesner, owner and founder of Yesner Law. I am solo, at least for now. Your financial coach, George Corbello, got called away to another meeting on the day of recording. So, I'll be handling this one solo, although we do have a guest today. And so, George may or may not pop on later. If he does, you'll hear his sultry tones when he pops on the Zoom call. But wanted to get right to our guest this week because as we are recording this, we're not quite to the business income tax deadline. But as you're listening to it, the business income tax deadline, the deadline for filing your business return will have passed and will be almost a month, probably less than a month towards when you need to file your personal return. So this person reached out to me and I thought he would be a great guest around this time of year for the show. So he is a graduate of the University of Michigan with a Bachelor of Arts in Psychology. He then earned his law degree from Loyola University. Wow, sorry, I didn't say that properly.
Yep.
Loyola, Chicago School of Law. He represents individuals and business taxpayers nationwide, successfully resolving cases with an in-depth understanding of the Internal Revenue Manual, which I think maybe the Internal Revenue Code is what I also called it. He
A little
prides
different,
himself,
but yeah.
there you go. Prides himself on being able to provide his clients with peace of mind during an extremely difficult time, which I know really well as a bankruptcy attorney as well. He is a member of the State Bar of Michigan. So welcome my guest and fellow attorney, Stephen Weisberg. Welcome, Stephen.
Thank you. Thanks for having me on. I'm looking forward to this.
Yeah. So taxes. Everybody loves paying taxes, right?
Yep, they love it. It's their favorite.
So I guess one of the issues that I face a lot, one of the issues that a lot of my clients don't necessarily understand when they come to me to file a bankruptcy, and I always ask them, do you owe the IRS? And some of them do, some of them don't, some of them do, but they think they don't. Some of them don't, but they think they do. And I get to this place where a lot of people just, they bury their heads in the sand. They don't file the returns. I
Yep.
just had a bankruptcy that I filed where my clients filed 2019 through 2023,
Yep.
and they're now working on getting 2024 put in. And so on the one hand, I'm like, how do you not file the returns? On the other hand, I'm worried because, and we can talk about, I want to talk to you eventually about dischargeability, but
Yeah.
a tax debt from 2019 that is just filed today is not going to be dischargeable. But
Right.
getting refunds in 19, 20, 21, and 22 and 23, I think all 3 years, maybe one of those years it's zero, but all the other years they're getting refunds. So do you have any insight other than, I don't know, embarrassment, not understanding? Do you have any insight into why people may not be filing their returns?
Yeah, and it happens all the time. So you're right. And certainly my clients, because this is what I do. My clients come to me all the time with no tax returns filed. I don't, it may be a little bit of embarrassment, but I think, well, I guess I'll step back. Generally, which is not the case, sounds like with what you were talking about, generally it's that they owe and, they think I can't pay it. And so I'm not going to file my return. Now, you were just talking about a situation where they were getting refunds. So that actually is a little bit of puzzling because if they were getting refunds, I don't know why they would be hesitant to file. Although I do see that, but much less so than when they actually owe money. So if in terms of refunds, yeah, I guess it's just maybe kind of like deer in headlights. They don't know what they're doing and they don't know how to address it and who to go to. That's the only thing I can think of. Because even embarrassment is that, if you're getting refunds, nothing really to be embarrassed about, right? So I don't know why someone with refunds wouldn't file.
Well, wouldn't the refunds be reduced by any penalties or interest that would be owed for filing the return late?
Yeah. You mean embarrassment that they didn't file it initially, you're saying?
Yeah, in other words, as we're recording this is 2025, and so if they filed a 2019 return, and that return, if it had been filed in 2019, they would have gotten $1,000 refund, for example.
Right.
If they file it in 2025, they may still get a refund, but it's going to be less than $1,000 because isn't the IRS going to take their cut of penalties and interest for not filing the return on time?
Well, refunds only go back a few years. I think it's 3 years, if if I remember correctly. Now, I could be wrong, but I think it's 3 years. But that being said, yes, any refund that you get will go against any tax debt that you have. So there's no reason not to file if you're getting a refund. Um, whether it's on time or it's later, and even if you're not going to be able to get the refund because you can only get it for, let's say, 3 years prior, still there's no sweat off your back. I mean, you just don't get the refund, but at least you have the return on file, so you're in compliance with the IRS, because the only time the IRS will help you and negotiate a resolution to your tax debt is if you have all your returns on file. So, if you have, just making up numbers, $20,000 worth of tax debt, and let's say you had a return from 2019 that you didn't file. You can't resolve it with the IRS. You can't start a negotiation with the IRS to resolve that $20,000 because you haven't filed 2019 yet. So you have to file all your returns. And I guess the point is, refund, not refund, anything in between, you need to be filing your returns, because that, especially if you have tax debt, but you should in general. But that's how you can actually resolve your tax debt. And not only that, if you do have a return and you owe money on that return, filing the return is better. Even if you file the return and you don't pay anything, that's better than doing nothing, because there's a failure to file penalty that is up to 25% of what you owe on the return. That's just failure to file. There's another 25% for failure to pay. So that's up to 50% of what you owe. But like I said, there's 25% of just failure to file. So even if you don't have the money to pay and you file on time, you're saving 25% of the tax that you owed in penalties.
Wow. Okay. So if people want to get a hold of you, it's Weisberg.tax. So it's WEISBERG.TAX. And again, I'll put this in the notes. So anybody that wants to do that can just click on the link in the notes. But it's Weisberg.tax. That'll get you directly to Stephen. Or you can also visit his company page, which is the W Tax Group. Now you're in Michigan, right?
Yep, just
But
outside of Detroit here.
Okay, but you can do tax resolution anywhere in the country, or do you focus on Michigan?
No, anywhere in the country. My tax base or my client base is nationwide. As long as you are admitted to the bar in one state in the country, you can represent taxpayers throughout the country. It's administrative law. It's, like I said, that Internal Revenue Manual, which basically tells the revenue officers and the agents kind of what they can do and what they can't do, and how they need to handle different situations. And so it's not judicial law. It's an administrative law the government has come up with to kind of handle tax debts.
Okay. Well, and it's interesting because so you graduated with a degree in psychology. My degree was actually in accounting.
Okay.
I did not go on and get my my CPA. At one point, my kind of career path, my career thought process was that I was going to graduate with this degree in accounting. I was going to graduate law school, and then I was going to go take my accounting background and go work at the IRS for a little bit.
Yeah.
Then after working at the IRS, maybe I'd switch sides and start representing taxpayers.
Right.
My first job out of law school was in real estate law, and I just became a dirt lawyer. So,
Okay.
Never happened that way. But let's talk about some of the stuff that you do. So, in terms of, we talked about just tax debt in general. So you can negotiate with the IRS on the tax debt for somebody that owes. Is it? I notice a portion of your website also talks about state tax relief. So do you do both federal and state disputes or workouts, or whatever they're called?
Yeah. Yeah, we can negotiate resolutions is really what we call them with the IRS and the state taxing authority. They're different. They're not the same, but they have some similar components to it. The state actually can be more difficult to deal with than the IRS. You know, the IRS have some pretty as I mentioned, this Internal Revenue Manual again, they have some pretty clear guidelines about what can be done and what can't be done. And I guess the states do to some extent, but the states have so much less, money to actually implement these things that they take a much tougher stance on these things, and their resolutions aren't as good. But yes, uh, it, just as individual taxpayers, if you have tax debt, I'm able to talk to the IRS and come up with the best and most favorable resolution for you. Whether that's financially based or it's based on how much you owe, it's based on what could happen to you if we do it one way versus another way. I want to get the most favorable outcome for you. That might be a monthly payment plan where you just pay off the entire thing over, let's say, 6 years. But it also could be a financially hardship type payment plan where you are paying over a monthly basis, but you never actually end up paying off the entire amount of the debt that you owe because the IRS has 10 years to collect from you. So there are certain payment plans that are called partial pay installment agreements where you will pay something every month, but you never pay off everything that you owe. And then there's the vaunted offer in compromise, which you may have heard on the radio, which all these 800-pound gorilla national tax firms like to promote. And yes, they are real and they do work, except few people actually qualify for them. So, they like to say on the radio, basically like make it out like everyone qualifies, right? And actually most people don't qualify for them, but they're not lying in that they're real and it happens. Like there are times when, I resolved a $75,000 tax debt for $500, and I've probably done a lot of those, to be honest. And that sounds great, and it is great for that person.
Right.
But you have to qualify for it, and there's strict standards about it. It's income, expenses, assets, all that comes into play. So, you have $1 million home with no mortgage on it, you're not going to get a $500 offer in compromise accepted for $75,000.
Right. I mean, my understanding of the offer in compromise. So in bankruptcy world, we have what's called the means test. I mean, now that we're in 2025, the last major amendment of the bankruptcy code was in 2005. That's the amendment that put the means test in place. And my impression is that the means test analysis for being able to file a bankruptcy is similar, or some might even say based on the offer and compromise analysis, in terms of it's very, and I've had to explain to clients, a lot of the means test is based on the IRS. So in other words, the IRS thinks that your housing payment should be blank.
Right.
That's what the means test is going to say your housing expense is, whether or not that's what you actually pay.
Right. You're exactly right. That's my understanding as well. That it's, like I said, either very substantially similar or virtually the same. And so, yeah, like you said, they may say, again, making up numbers, your mortgage can be $2,500 a month, let's just say. Now, your real mortgage might be $4,000 a month, but that doesn't mean that the IRS, or in this case with the means test, they're going to accept that as a legitimate expense. Now, with what we're doing here with the IRS, you can make arguments. There's a lot of times you can make the argument and say, hey, I know the standards only say $2,500, but the actual amount is $4,000, and this is why we need to include that as a legitimate expense. So there is that negotiation going on, but the underlying understanding is we have certain standards. You need to stick to those standards. You can make your argument, and we might accept it, but for the most part, the standards are what the standards are.
Yeah. And the other thing I wanted to ask you about too, in terms of settling out debt, I've heard of this innocent spouse, I think is what it's called.
Sure. Yeah.
How does that work?
Yeah, that's, I mean, a good example is kind of, and it's a husband and wife. Let's just say the husband has a business. It could be either way, but let's just say the husband has a business. his own business. He's making money, and you as the wife, you don't know exactly what's going on. He's bringing home money from his business, and whatever he says it is, it is. Um, and he fills out his tax return, or the joint tax return for both of you, and he says, let's just make up numbers. The business made $100,000. Well, if the business really made $250,000, and he didn't say that, and the IRS comes back and says, no, you actually made $250,000, and we know that because of X, Y, and Z, then you got a huge tax debt that's owed jointly between the husband and the wife. So at that point, the wife can then, try to do the innocent spouse relief and give reasons as to why she should not have to owe the extra money. She didn't know about the extra money. There's again a procedure and things that you have to go through to explain why you should not be liable for that amount. And also, if you were used that extra money and probably should have known that it was more than $100,000, that's one of the things that they look at. But there's a long list of things that you have to go through. And if you can convince the IRS that you really were not in on this and you knew nothing about it, and your husband kind of was doing something under the table that you just weren't aware of, you can be granted innocent spousal relief. There's also one more, which is injured spouse relief. And that's a little bit different, but people just get confused. But the injured spouse is if you get married, let's say, and you're filing jointly, and your new husband or wife has tax debt that's owed to the IRS, and then the IRS takes the refund from your jointly filed tax return, you can then say, well, I'm injured as a spouse, and you took my refund, but I had nothing to do with the tax debt. That was my husband's tax debt before we got married. And in that case, you can get refunded your refund.
Got it. So, I mean, it's because I was going to ask you, my understanding of innocent spouse is it typically applies like in a divorce situation. So we got divorced, but before the divorce was finalized, we filed jointly because we were married. And now the IRS is coming after me for all this debt that my ex-spouse owed because of what he or she was doing with their business. That was always kind of my understanding of innocent spouse, but it makes sense that if that's correct, an innocent spouse is in a divorce situation, injured spouse would be the flip side of that coin.
Right. And yes, I mean, I think you're right. That probably does happen, especially when the two people are at odds after going through a divorce, and then this tax debt comes about, and the wife saying, I didn't know anything about this. My husband, made all this money, and he said he only made a certain amount. And I signed off on it because that's what he said he made, but I didn't know anything about it. I didn't know that he made, two times as much. And there's, no love lost there. That happens a lot in those situations.
Got it. So I know there's how many other different types of taxes, but what other types of taxes primarily do you see in your practice that you're helping clients get rid of?
Sure. Well, income tax that individually is the most prevalent, of course. And just to add on to that, a lot of people who are self-employed get caught up with with the income tax debt because, they're not W-2 wage earners. They're not getting a paycheck every biweekly or whatever it is, where the taxes are just taken out of their paycheck and they don't have to think about it. They have to make quarterly payments. And they'll just say, oh, I'll just make it up at the end of the year. And then at the end of the year comes and they owe a bunch of money and they realize they can't actually make the payment, then they owe money to the IRS. So, what I would say there is just make it as automatic as possible or automated as possible each quarter that your money goes to the IRS. That said, I also work with a lot of business owners, and something that happens with business owners is first of all, we just talked about your paycheck and how your taxes come right out of your paycheck. Well, that's the responsibility of the business owner to take the taxes out of your paycheck and then deposit it with the IRS. What happens sometimes is these business owners, let's say cash flow is low for the month or for the past 6 months. They have a vendor that comes to them and says, hey, I'm only going to give you supplies and goods if you pay me up front because you've been late or whatever it may be. And the business owner says, well, I don't have the money to pay you, but I do have all of these taxes, these funds that I took out of my employees' paychecks that I'm supposed to deposit with the IRS. I'm going to give you, vendor, that money that I'm supposed to deposit with the IRS. That doesn't go over very well with the IRS. That's also called stealing. Especially when it's not your money. It's not just that you didn't pay the IRS what you owe them. You're taking other people's money that you're supposed to give to the IRS on their behalf, and then you haven't. You've used it for something else. So there's a lot of payroll tax issues, and I represent business owners in that regard. Now, because the IRS believes that's stealing, and I think it probably is.
Probably.
Yeah. There's also a personal component to it. It's called the trust fund recovery penalty. And so if you are a business owner and there's some legal definitions or terms being used, if you're willful in doing what you did and you were responsible for doing it, then you're hit with this trust fund recovery penalty. And the trust fund recovery penalty is a personal tax. So even though these payroll taxes were business liabilities, you're now getting hit with a personal tax, just like an income tax. So you personally now owe money to the IRS.
Wow. Is it something I would assume for that reason, if the business just paid it, it would not be a deductible expense to the business if it's a personal tax, or it would be probably something similar to either a dividend or a distribution or a membership draw or something like that.
Right. The business can't pay the personal. You've got to, and I'm sure there's some accounting ways. I'm not going to get into that,
Right.
but yes, the personal, you need to pay yourself personally.
Okay. And you also do some audit defense, right?
Yes, we do a lot of improperly assessed taxes. So, you send your return in, it gets pulled. The IRS says, look, we think X, Y, and Z is happening, and you didn't report this, and what you took too many deductions, whatever it might be. We then fight on behalf of the taxpayer to make sure what the IRS is saying is correct, because I'm not going to say the IRS is out to get you, and I don't actually think they are, but they do make a lot of mistakes. I can tell you that. So, when you get one of those letters that says either you're being audited or just, what's called like a correspondence audit and says like you didn't report all of your income, you want to make sure that that's actually correct. And that's kind of where I come in to go through the procedure and the permutations to make sure that, you're not getting charged more in taxes than you actually should be.
Okay. So one of the reasons that I had my degree in accounting is because my dad was a CPA for years and years. And so I thought, number one, if law doesn't work out, I can fall back and be a CPA with him. And two, I had a free tutor going through my accounting classes.
Right.
He always used to talk about what he would call like red flags. So if you do, so I remember one year when crypto was popular, I did a Coinbase thing and I got some crypto, not a lot. I think I put in a couple of $100 and it's gone down to, whatever, 10 cents.
What do you mean? It's probably worth millions now.
Yeah, it's probably worth, I think I put in 150 and it's probably worth like 175 right now.
Okay. All right.
But one of the things that he said is that, buying and selling crypto is an audit red flag. So how many audits do you see, and are there certain things that you think, I mean, again, I know it's there's no exact science to this, but
Yeah.
are there things that you see that might lead to an audit over, something else? Are there red flags that the IRS picks up on?
Yeah, definitely. But to be honest, audits are extremely low right now. I don't know what the percentage is. I think it's single digits. It's very low, and certainly with the cut in the new funding that they were just given, about half of that was clawed back, and then there's going to be, there are and will be more layoffs at the IRS. Audits are not going to be all over the place. Now, that doesn't mean you should just try to get away with whatever you can, but there's not a ton of audits. That said, there are red flags, especially with business owners or if you're self-employed. The home office deduction. I wouldn't say it's a red flag. You just want to make sure that you're papered up and you've done it properly. That the area that you've used is exclusively used for business purposes and primarily used for business I should say exclusively used for business purposes and primarily used for business activities. So that's one that they look at. mileage and vehicle expenses on a business return is big one. I shouldn't say business return. I should say on a Schedule C, on a personal return.
Right.
Mileage is a big one. If you are, I don't know, let's just say a lawyer, and you're working at your office all day, or anything where you're not driving that much, and you put down that, this insane amount of mileage, the IRS looks at that and says that doesn't make sense. So, we're going to audit right there. So those are two big ones. The other one, which is an easy one, is, if you file your return and you don't include all the income that you received for the year, the IRS already knows for the most part, what income you received. So like if you get a W-2 from your employer, the employer sends that W-2 to the IRS as well. If you get a 1099 for some self-employed work that you do, the person that paid you and gave you the 1099 sends the 1099 to the IRS as well. So if you don't include everything on your tax return in terms of your income where you received the W-2 and a 1099, the IRS already has that in their book. So that's a real easy one. It's an automated, automatically spits a letter out that says, we know you made this amount, but you said you made this amount, what's going on here?
Well, it's interesting because the law firm gets 1099s for when sometimes when clients pay me legal fees or settlements or whatever, the law firm will get a 1099. I don't think it's ever come to me personally. Now I
Yeah.
just file it away because I use QuickBooks. And so
Yeah.
the client paid me, $5,000 retainer for whatever, and then that company sends me a 1099 for $5,000. It's my books show that I got it,
Yeah.
but there is no individual entry within the law. And the law firm is my law firm is a subchapter S. It's tax.
Uh-huh.
It's an LLC. Tax is a subchapter S.
Yeah.
But there's no individual entry in the books. There is no individual entry on the return that says, hey, this client paid this and this client paid that and this client paid this. So I've just, every time I get it, I guess I need to make sure that it's in the law firm name versus my name. And then I just file it away in my receipts because it gets buried in there.
Yeah, yeah. I think as long as you have it all in there, and but I mean, you're right. But as long as you're identifying all the income that came in, with like the subchapter S, it flows to you, individually anyway.
Right.
You should be good. But yes, the point is, if you get a 1099, the IRS has that 1099 on their books as well. So there's kind of no getting around, filing without reporting all the income.
One thing that also kind of just occurred to me, 1099-C, forgiveness of debt income.
Uh-huh.
I was heavily involved in short sales and loan modifications and negotiating all those for my clients. And I know for years there was an exclusion if you got a 1099-C for forgiveness of debt income against a mortgage. You did a short sale on your house and the bank waived the whatever $20,000 deficiency, and now a $20,000 1099-C shows up.
Yeah, I remember that.
There was a law that said if it was related to the sale of your primary residence, you don't have to pay. You still got to, I would tell clients, you still got to report the 1099,
Right.
but go to your CPA or accountant or attorney or whatever and file the other forms. I think it's a I don't remember, I want to say 942, whatever the form is that you tell the IRS, here's a 1099-C income I got, but here's the other form that says it's not taxable because.
Right.
Do you know, are there still, I don't think there are, but are there any other exclusions if today you were to do a short sale on your, and today, let me clarify that for the attorneys, as we sit here in March of 2025, is there any do any of those exclusions still apply? Do you know?
Yeah, I don't know. I mean, I think that was, primarily based around, the 2008 and everything that was happening there. I don't know if there's still that exclusion. And I'm not going to say whether there is or not because I'm not sure, but I would think that there isn't, and that probably lapsed at a certain point. But I could be wrong. So we'll have to
Yeah.
look that up when we get off of here.
And I think I tend to agree with you that it's lapsed. And I remember making the argument. So I had a borrower come in who had been represented by another attorney for years and years and years and years and years. And I said, well, they did a great job of postponing the foreclosure, but they postponed it for so long that this house is so upside down that if you were to get rid of it, you might have to pay taxes on the forgiven debt.
Yeah.
because they extended the foreclosure beyond the law that would allow you
Okay.
to exclude the forgiven debt.
Yeah, yeah. I mean, again, there's a lot of those things, little things, I guess, little big. There's a lot of things that go on with the IRS. Like you talked
Yeah.
about the code, there's 1 million different caveats in that code. It's a huge monster book. You know, it needs to be reduced to about maybe a quarter of what
Right.
it is. But right now, it is what it is. It is very difficult to interpret on your own, and to some extent, that's why I have a job. So
Yeah. I don't know if I heard in law school all the time, the immigration laws, the bankruptcy code, the tax code, um, were all called three-finger codes. In other words, you read whatever section you think is primarily applicable, and then it references another section. So you got to stick your
yeah,
finger in there and flip the page to the next section, which
yeah,
then references another section. So you got to stick your finger in there and flip to
yeah,
the next section. And so by
yeah,
the end, you've got 3, 4 fingers shoved
right.
different places in the code.
Yeah. That said, so early on in my career, I was in corporate bankruptcy. I liked the bankruptcy code compared to this code, compared to the IRS code. I liked the bankruptcy code. I thought it was like you were able to follow along, like you said, your fingers here, fingers there, but it wasn't like just so like out of control. I mean, listen, it was big, it's hard, there's a lot in it. I thought it was more, straightforward, I guess is the word than the IRS code.
Yeah. Well, speaking of kind of last thing, I mean, especially as the bankruptcy attorney, this is a podcast about getting rid of debt. And so I do want to talk to you a little bit about when a tax debt might be dischargeable. So I would say, can you give us a very basic, very 50,000-foot overview of a dischargeability analysis for a tax debt, for an income tax debt?
Well, I think you should tell us what the dischargeability is. I know there's the 240 days, there's a list of things that needs to happen for it to be discharged. But listen, I go to my bankruptcy attorney friends and I go to them, I say, look, can this be discharged? In your opinion. So I know there's rules. I know, things need to be filed timely. I know there's specific instances where it can be discharged, but like you said, there are plenty of other instances where it cannot be discharged. And that's, part of the referrals that I get are from bankruptcy attorneys who have gone through bankruptcy where death were discharged, but certain tax debts could not be discharged because they didn't meet the criteria. And then they come to me and I'm able to finish it off and negotiate a resolution for the tax debts.
Yeah, and that's a good point. In other words, if it can be discharged, maybe the bankruptcy is the better option to eliminate the debt.
Right.
Sometimes, even if it can't be discharged, I've said a bankruptcy might be a good option because then it would come to somebody like you afterwards. And if I've bankrupted everything else, I've freed up whatever money they were using to make their minimum credit card payments. And, they don't have to pay that stuff anymore. So
Right.
that money can now be applied towards whatever resolution with the IRS. But to kind of put a bow on my own question, my understanding is that the debt has to be more than like 3 years old, but the assessment of the debt, and I think that's where a lot of borrowers don't understand. I think the assessment of the debt also has to be more than, I think, around 3 years old. So for example, we brought up at the very beginning, the 2019 tax return. Well, as we're here in 2025, 2019 was 6 years ago. So we meet that first prong.
Yeah.
But if you just file the return today, the assessment of the taxes from when you file the return, so it would not have been assessed long enough ago. And so
Right.
it might still be, it still would be non-dischargeable.
Well, I guess we'll think about that.
Something along those
If
lines.
it's assessed though within that 3 years, I think it's non-dischargeable. Is that what you just said? Yeah,
That's
I
what I
think.
just said. If
Oh,
it's
yes,
assessed
you're
within the
correct.
3 years,
I
it's
misinterpreted what you
non-dischargeable.
said, but yes, you're correct.
Okay. Okay, cool. So sometimes I do know what I'm talking about.
Yep, you knew exactly what you're talking about. I misheard you.
So, um, before we kind of get to the end, is there anything else you wanted to talk about or anything else I forgot to ask you?
No, nothing else. There's a lot of kind of, to be honest, bad actors in the tax debt world, and it gives us a bad name.
Yeah.
There's those, and I'm not going to mention any names, but you hear them
No.
on the radio. Make sure you get a referral from someone. If you don't have a referral, maybe go meet someone locally. If you need someone and you don't know where to go or where to turn, I'm happy to help. You've got my website is weisberg.tax. It's Weisberg.tax. My company is the W Tax Group. Reach out to me. I'm happy to help. I'm happy to talk you through whatever's going on. Even if you decide to do something else or use someone else, that's perfectly okay. I'm here to help, and I look forward to hearing from you.
Yeah. Yeah. No, I appreciate that. And again, for anybody listening, Stephen, the website says free consultations, and Stephen can practice anywhere in the country. So if you're having issues with your taxes, you can certainly contact him. You can contact me. You can only contact me, however, if you're in Florida. My license is limited to Florida, but Stephen can help you with the IRS and with state taxes anywhere. So again, it's weisberg.tax. I'll put all that contact information in the notes. Well, thank you, Stephen. We appreciate you being a guest on this week's show.
Yeah, thank you. Appreciate it. I'm glad to be here.
Yeah, before I wrap up, I do want to mention a couple things. So if you want to support the podcast, you can go to our Patreon page. That's patreon.com/crushingdebt. Also want to mention my friend and sponsor, Sam Cohen. So I don't know, Stephen, you don't have to answer this question, but if you need malpractice coverage, Sam works with Attorneys First Insurance, or owns Attorneys First Insurance. He provides malpractice coverage to attorneys and title companies all over the country. He is a great friend, sponsor of the show. So thank you, Sam. I also want to mention we are still in the process of raising money for the Pancreatic Cancer Action Network, the PanCan Purple Stride Walk, in honor of my late wife, Melanie. So we're still raising money there. I'll put the link to our Purple Stride team, which this year is April 26th of 2025. And it happens everywhere. So even if you're listening out in Michigan where Stephen is, I'm sure there is a PanCan walk on April 26th somewhere, multiple places, probably in Michigan. But again, I'll have the sign up for that in the show notes as well. Other than that, I think we've reached the end of the show. So thanks again, Stephen. Attorney to attorney, I appreciate it.
Yeah, thank you. I appreciate you having me on.
Yeah. So I will sign off like I do at the end of every episode. And especially if you've got tax debt, we hope that you have more money at the end of the month rather than month at the end of the money. And we will talk to you in next week's episode.